So hi guys, and welcome back. Tortilla's interim results. They're kind of the Chipotle in the UK and Europe. Let's have a look. This is the team, and this is the agenda. I'm going to whiz through this. Make sure to keep watching. Okay, they've acquired a big brand in the UK, Chilango. It's a competitor in central London. They've achieved new site rollouts, adding 5 sites and 1 delivery kitchen, all outside the London bar and delivery kitchen. They commenced franchise partnerships with Compass Group, and they've added another airport, which is fantastic. And great performance during the summer in travel hubs proves the suitability of busy travel locations, and also shows, I don't know if anyone else is watching my other videos about listed equities, but Catebox, another franchise in the UK, suffered pretty badly in the summer because of the hot weather. But Tortilla didn't have a problem. Okay, so they signed a deal with Uber Eats, which is good. They've got a pipeline. They're confident of exceeding original targets of 45 sites over 5 years. I really think they should be pushing for 100 or 200 sites over 5 years, but that's just me. They launched a new loyalty scheme. Revenue increased 30%. Adjusted EBITDA was down. I'm going to have a look at why that is. I think I can see some obvious things here for some reasons, but let me go through this, and we'll also look at some more detail a little bit later on. Strong balance sheet with net cash 3 million, compared to 0.9 in the first half. Okay, whoopsies, I'm going the wrong way. Next slide, financial review. This is my domain, really, looking at the numbers. I'm not going to look at this. Well, actually, I'll just look at this one that's popped out. Gross margin was 77%, which is pretty high. It's higher than Catebox, which is about 47%. I think it might be higher than Domino's Pizza as well, which is fantastic. Admin expenses increased by 31% to 20 million, in line with revenue growth. So I guess, as they expand, their admin expenses also expand. EBITDA was down due to increases in VAT, less government support. Underlying increase was due to the growth of the existing site and additional new sites, and also maybe Chilango, buying that. I don't know how much that costs. So profit was only 0.3, so they've lost about 2.1 million on that. But as you can see, increase of VAT is 1.8, and then government support, restart grants, less of that. Yeah, so that's not good. Because that means that their profit is not going to go back up to that. But let's see. Revenues, everything's growing about 30%, which is good. So let's keep watching and let's see what they're saying. Actual like for likes up 18%. So that's growing. Sales like for likes, excluding zone 1, up 25%. This is really good, especially for a difficult time of year. Revenue sales channels looks like in-store is growing, which is good, but their loyalty scheme is also growing. They've got 212,000 people on their loyalty scheme, which is good. They wanted to partner with Uber Eats in July in addition to Deliveroo, which stressed the slow digital like-for-like sales growth. It's well suited to delivery, obviously. That makes sense. Gross margin, pretty high actually, 77%, but let's have a look. It's 2% lower than expected. Protein costs have gone up. Expected to be 3 percentage points with an EBITDA. What they're expecting full year EBITDA to be 1.8. Let's remember that number for later on. Inflation 6 to 10%. They don't want to input prices up because that undermines their offer. Completely agree. Don't want to put up prices too quickly. Utility costs, they didn't choose to hedge. Okay. An extra 500,000, which is crazy, of costs for utility costs. That's interesting. They're continuing to buy spot, which they're saying is a saving versus forwards. That's because they didn't hedge earlier on, of course. So they're now making up by buying spot, hoping that prices decrease. Buying spot just means buying like trading now, versus a forward, which is buying energy in advance or buying a commodity in advance. In this case, energy. If they had done forwards previously or hedged then they might have offset that cost anyway. That is a cost into learning. They do have a young team. And maybe other companies haven't done this either. Maybe they haven't hedged, properly. So anyway, it's comparatively less. They're saying it's not that significant, but it does seem significant. $500,000, add $500,000 on to the EBITDA, and it goes up by 30% or 40%. So it does seem considered. Yeah, but anyway, fantastic performance. Already 110% of sales hurdle required to hit 30% return on capital employed investment case. This is a metric I use a lot, by the way. Return on capital employed is like the base return on investments, and it's a really important number. 30% means the company's going to grow like wildfire. Anything above kind of 20% is really good. I think Warren Buffett looks for 12%. So 30% is pretty damn good. If we look at the openings, Edinburgh, Exeter, Windsor, Bath, blah, blah, blah. In fact, we were in Bath actually looking for the Tortilla, but it's about a mile away from the station, or it was raining actually, so we didn't walk to the Bath. But anyway, look at this, 15% of weekly mature target, and they've only opened quite recently, which is good. So they don't need to tell me this. Like I know that there is a shortened maturation space for Mexican restaurants as their penetration increases. As they grow their store account and space, more people are going to know them. It's going to take them less time to make money. That's just logic. It's obvious. Same with Domino's Pizza, same with Cake Box. Your brand expands and people know who you are, and they're more likely to visit you, and blah blah blah. Great conditions for rollout. They want to secure as many affordable units as possible. Recession period is the ideal time to expand. They intend to sign long leases. They want to roll out to 12 to 15 sites. I think they should be more aggressive than that, to be honest, but that's just my opinion. They want to leverage additional flexible new site criteria, ability to take on former units where they need to install. So they want to look at restaurants, basically previous restaurants and takeaway joints, so that it's a faster fit out. That makes sense. There you go. The goodwill, that's a cost of 2.6, right? So if we think about the profit, I think it was 0.2. Add in 2.6 is 3 million. So let's go back a bit just to have a look at that. Yeah, so 2.6 onto this would be 2.8 million. Now, granted, that might not necessarily have gone the whole way there. So that take away 100K and it'd be 2.5, which would be 10% above the H1 final year 2021. So that's something to bear in mind, some of these things. They had all these costs as well, about 2.4 million of extra cost, plus they spent 2.6. So that's like 5 million differential. So if you think of it from last year, it's up. Profit would have been up about 150%, but they had this reduction in government support and whatnot, and they bought Chilango. So the government stuff is not going to come back, so forget about that. But they're probably not going to be acquiring Chilango style companies every year. So I would imagine that like the half year profit would be around 2 or 3 million every year from now. And obviously Chilango might have additional, might drive additional revenue as well for the future. Let's go back to where we were. So they're saying this goodwill. Goodwill, for anyone that doesn't know, goodwill is like how much you pay for a brand. It's often like a pseudonym for like how much more you needed to pay for the kind of brand recognition. It's like the extra that can't be accounted for, or it's another way of saying the purchase costs. Yeah, goodwill. That's a goodwill payment. Anyway, net cash of 3.2 with debt of 3 million. It's good to have cash in this environment. I think they're a strongly cash generative business anyway, but it's not a bad thing to have cash. They've got a high liquidity, highly cash generative, self-funded rollout, reconciliation of the opening closing costs, blah, 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 as follows. Opening balance, blah, 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 2.5 for Chilango, 2.7 for Chilango. Yeah, so a lot of that is, if you look at 3.2 plus 2.5 would be 5.7. The rest is kind of miscellaneous costs, maintenance they've got here, and capital, just general capital expenditure and some rent. That's all fine. Nothing to be worried about there. Right of use assets. Is that like they're putting that as an asset? Is that like lease, their lease costs, like the right of use of the lease assets or something? I'm not sure why that's an asset. That's a little bit unusual. Not seen that before. Whatever. We can look at that later. Trade, that's fine. Cash is an important one. This is a bit confusing, actually. I haven't seen that before. But anyway, even though I've looked at these kinds of things for 15 years, nevertheless, let's move on. Trade, another payables. That's not good, actually. They've got 3 million right there. But these are in the half, so you don't know how they're stacking for the whole of the year. Loans has gone down a lot, so they're repaying their loans and they're borrowing pretty well. Net assets, total liabilities, net assets. It's really important to understand about this right of use assets. Maybe on a future webinar, I might ask about it because I don't understand what that means. I think it's basically they might be trying to create an asset from the leases they own. Potentially, I'm not sure. It's a bit unusual. All right, let's move on. I'm not that worried about it because they're so cash generative, to be honest. And this is reflective of like a lot of the places around the country. We've been to Tortilla in London, in Birmingham, and we've seen lines everywhere. All right, so they've acquired eight stores and retained 1 delivery. 5 locations from Chilango have converted to Tortilla. Some will be retained because they don't want to cannibalize by having too many tortillas next to one another in terms of proximity, which is an important metric for quick service restaurants and fast food and restaurants in general. Commence to try the brand of virtual concept, some kind of cloud kitchens. I think that's great. I'd love to have that near me. I'm in Hertfordshire. I think that would be fantastic. Early signs are strong. Channel sites for great locations. This is all good. Sorry. Let's go here. Where are we going now? Spread of profits around the UK. We know this. This is fine. New stores, 100 site target by December 23. Let's look at this. This is important. They want to increase 12 to 15 a year. I think that's pretty slow, in my opinion. I'm just going to say, it's my opinion. I think it is pretty slow for a growth brand. Kaki, which is some kind of like consultancy firm, provide property analytics, blah, blah, blah. They've identified another 200 locations in the UK. Listen, guys, you don't need to pay a company like that. You can see places like where the Domino's are, where the Greggs are, where your competitors are, where Leon restaurants are. I'm not sure they need a consultancy to pay for that, but maybe they want to have the confidence of, it's specific to Tortilla, maybe. I don't know. I kind of feel that Tortilla would thrive in most locations, but maybe that's just me. Anyway, let's have a look. On track to deliver 11 this year, which is good. Maida Vale, since been closed along with Brent Cross. This was a condition of non-exclusive trading relationship on delivery. Oh, because they're doing deliveries or something. Okay, whatever. That might be a delivery. That's probably because they're doing delivery restaurants. Okay, fine. 5 in H2 are our 4 stores located in Lincoln, Leicester, Coventry, Durham, and Canterbury. These are good locations in the UK. Canterbury and Lincoln, maybe Durham, are big tourist areas. Leicester, Coventry has a big university population as well. Durham, I think, has a good university. Excuse me. Bankside lease surrendered. Wasn't commercially viable due to Southwark site only 0.3. So this is really what I was talking about earlier. A lot of brands do look at proximity as a big metric. And this is interesting with Tortilla. They had another site 0.3 miles away, and they couldn't afford to have both sites. Domino's look at a 1 square radius. How do I know about Domino's? I invested in Domino's for 10 years. The company went at 10x. Right. And they have a 1 mile radius rule. I invested when they had 100 stores. I think they have 1,600 now or 1,500. I no longer invest in Domino's, actually. I prefer the kind of smaller companies, whatever. Anyway, 3 Chilango cloud kitchens close. Okay, fine. Already well progressed for the next 12 sites, 3 Exchange London, 1 head of terms, is that? Agreed in Midlands, and 1 in Northern Ireland, which is good. I'm going to talk about my opinion about how they could think about sites a bit later in the video and some of the paths they could consider. But let's carry on. Geographical. Oh, we've seen this already. My bad. Going the wrong way. Value for money. This is really important, actually, and I'm glad they've done an analysis on this. I don't know if this was Cappy or them. Inflation's already about 10%. We know that. So they've got room to offset. Blah 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 blah. They're good value. They've done some research on this. Like these are all the other brands. I'm not going to spend too much time on this. Maybe you could see how many you recognize in your country if you're not watching this from the UK. It is interesting. I do think that Tortilla are very well priced. And I think that is a really strong kind of growth metric for them. If they can keep that stable as prices, they can keep growing. Okay. Current trading outlook as of September. They've opened the new sites. Blah, blah, blah. Sales momentum, 16%. Like for likes. It's pretty good. Yeah, the loyalty club offers a chance to drive frequency. I don't know how much that's going to drive frequency. Might add a little bit, maybe 10%. But I don't know how much that's going to drive it. Possibly. We'll see. They're talking about inflation here. Yes, inflation is high. We're aware of that. I actually predicted it, of course, in 2020. Anyway, whatever. Not talking about me. Summary. They're encouraged by like for likes. There's no openings. It's value for money. They're cash generative. They're going to mitigate headwinds to return to profitability. They want to ramp up. They want to pursue European opportunities. They remain highly confident. And there's some Q&A here. There's an appendix. This is similar to before. Got a new board appointment. So she's done some QSR expansions. This is Francesca Tiritiello. Tiritiello. Is that like, sounds like Italian or something. She's worked for Yum Brands, which is good. It's a very good brand to have. And she's probably done rollouts. So that's great because they should be thinking about rolling out. Okay, was there anything else? They got a good product proposition. Bum, 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 bum. They've won awards. There's the different this is the different store sizes and counts. It's good. Some of their I think a lot of their stores earn about $1 million. So yeah, in revenue at least. So I suppose maybe that's where the capex comes in. They spend 300, they get $1 million or so back. Maybe 30% of that's profits. That's where they get their return on capital metrics. Here we go, return on capital. Anyway, here's the org chart. It's a small organization at the moment, but it's growing. They have a CPU, a central whatever you want to call it, commissary or central production unit or hub. And that's in Tottenham Hale in northeast London, not too far from one of my houses. One of my properties, rather. I don't only have one house, as we talk. No, I have 2 houses. Anyway, it's in northeast London. Very good. People and culture, blah, blah, blah. ECG. All right, I'll stop sharing. Talking about my opinion. I wouldn't worry about the drop in profits because of those 2 one-off extraordinary things happening. You know, the Chilango acquisition and the government support stopping. So I wouldn't worry about that. I do think they're growing quite slowly. Maybe they're growing at the kind of, one second, I'm going to slightly turn down the volume here. I think they're growing like quite slowly. The reason why I think that is because the other companies that I invested in were growing faster. I think they're probably a nervous team. They've said before on other videos that they didn't want to overexpand and things like that. But I think they could grow quicker. Number two, I think there'd be no reason why they shouldn't think about crowdfunding to expand the team and grow faster. I think they should really be looking at kind of 25 to 50 stores a year. They've got a successful format. They've got a successful product. It's the right time for, value for money, high quality, healthy food like Tortilla. But anyway, they only want to grow at 12 to 15 stores. Nevertheless, watch their prospects. Well, I think they're going to make, probably somewhere between 2 and 5 million a year in EBITDA. Maybe not this year, maybe next year or the year after. I always try and think of investments as 2 to 10 years. Tortilla is really, really poorly valued in the market at the moment. Let's just quickly share my screen and you'll see, kind of the feeling of people's. One moment. Why is this not working? Can you tell I work at a tech firm? Here we go. One sec. So yeah, I think like the whole market is kind of pricing down a lot of things at the moment, and Tortilla share price is just plummeted. And yeah, it's gone up like 1% yesterday, but over the past year, it's really super plummeted from like 200 down to 87. I am an investor. I bought along the way. I bought IPO. I bought IPO and I bought like about 100, 150, both in my pension and my normal shares account. I think this is a ridiculous valuation. 30 million is just silly. Like I said, I think they're going to be earning 3 to 5 million within 2 years. So at 20x, 5 million, they'll be worth 100 million. That's 3x where they are now, which is about 240, which is kind of where I think they should be, about 150 to 200 right now, is where I'm at. But obviously I think fairly logically, and I think the market doesn't. That's the nature of the market. It's the collection. It's the collective view of everybody buying and selling in the market, and most people, are dominated by fear or greed. Logic doesn't play into it. So I do think Tortilla's share price is really low, and they don't offer a dividend, unlike Cake Box, which has an incredible dividend. I do think there's a lot of similarities between the two. If we look at Cake Box shares for a moment, they're valued at 46. Again, it's fallen, just enormously, despite growing, being a growth fund company. But look at the dividend, 6.6%. It's just madness. And Cake Box have done, similar things in terms of investing their infrastructure and things like that. But the difference between Cake Box and Tortilla is that Cake Box pays a dividend, and it's a bit more unique actually. I think somebody could create another Tortilla pretty easily actually. They've only got like, what have they got? 80 stores, 100 stores. I don't know. They don't have that many stores. So if anyone wanted to be aggressive and build like 20 stores a year, within 4 or 5 years, they've got more stores than Tortilla. Whereas Cake Box, like, there's just nobody that has the incentive to do that. And they've got an egg-free product. So I do think it's interesting. I'm going to stop sharing my screen. I do like Tortilla. I do struggle sometimes with like whether I should be spending, investing more in angel investments or in listed equities, because I think there's so much value in listed equities, as you can see. But I do get slightly frustrated with the speed of listed equities. They're so much slower, than angel or venture backed companies. Just the way it is. I've done a video on the differences between angel investing and investing in shares. It's just kind of round one video, if you like. I'm sure I'm going to be doing more of these, but if you're interested in looking at that, if you have the same dilemma as me, then check out that video. Might help you to have another perspective maybe. Hope you enjoy this video. I really enjoy making them. Don't make any money from this channel or anything like that, but if you do want to support, best way is to smash the like button, consider subscribing. You'll get up-to-date updates like this one, both about listed equities like Tortilla or Cake Box, as well as some angel investing, and really cool companies that are out there. Remember, knowledge is power, especially what kind of knowledge, Pro 7. See you guys in the next video. Take care. Cheers.